Let's bring in Amit Joshi. He's Associate Portfolio Manager at Barometer Capital Market. You can see that the bank stocks have underperformed so far in 2023. And in fact, over the past year and even 2 years, the performance on it is not great. And we look to these bank stocks to kind of be stable, provide us that dividend. And recently, it hasn't been delivering. How are you thinking about the group right now?
Good morning, Amber. Thank you for having me on the show. Yeah, you've kind of summarized it there. Underperformance by the banks relative to TSX, a variety of reasons. We've seen kind of the issues that we saw south of the border with the U.S. regional banks. That's made investors jittery in terms of space. And, where the multiples are currently, we're definitely in a spot where the banks are already kind of pricing in a recession. So towards the end of this year or early next year. So that's had investors being jittery, holding the bank stocks. But as you mentioned, dividend yields for the group average still very strong, sitting at about 4.8%. And when you look at multiples, it's trading now kind of at 9 times next 12 months earnings. That's 10% below their 5-year average. So we're at a place where we think the banks themselves are pricing in the worst case scenario in terms of a recession towards the end of this year or early next year.
So that sounds like a setup for a good trade. Low valuation, pricing in the worst case scenario that we're not even sure is going to show up because we've been waiting for this recession for quite some time. Are you viewing this sector as a buy right now?
For us, it's a wait and see. I think the positives are the consumer is still very strong. We've seen that in the economic data. We've seen that, in the strong jobs data as well. So that there in itself is one of the keys. And when we look at credit and the credit picture, we see a normalization, but we don't see a crack in credit so far. So far, so good on the credit side. I think when you have that, you have the stability with the banks. The Canadian banks are different from the U.S. in terms of being very well capitalized, especially compared to the U.S. regionals, and just having that sticky deposit base. So yeah, I'd agree. I think we're pricing in a recession. Multiples are at a lower end of the range. I think you just want to see stability in credit and performance from the banks themselves. We want to watch out for revenue growth. So Paul mentioned as well, the net interest margin is something that we want to keep an eye out on. Funding costs have been ticking up higher, so that will be a key focus this time around.
So let's take some of these banks one by one that you do own into the quarter. National Bank is actually the best performing out of the large banks so far this year, up 12%. It was recently downgraded in part because of that outperformance. You talked about multiples. This one's trading at a premium versus a historical discount. The analyst was noting things like increased competition in Quebec, which it plays in, outsized exposure to capital markets, which have been weak. How do you think about National Bank? Where does your conviction come from?
Yeah, when we look at National Bank, I think, some of the items that you've highlighted there are reasons we do like it as well. The capital level is towards the higher end of the range for the group average. They do have the geographic exposure to Quebec. And when we look at the loan data so far this year, they have been outperforming year to date. So, the setup for National Bank going into the quarter actually looks very, very strong. And I think that's the reason why it's trading at the premium that it is.
And TD is the other side of the coin. It is trading at a historical discount to where it typically trades. It's the worst performing. And everybody looks at, its capital levels. They have a lot of good things to say about its exposure and how it's positioned. And then there's always the but. But can management deliver? Can it do what it needs to get into the U.S.? Some say it's shut out of the U.S. for the next 3 to 5 years. How do you think about owning TD here?
Right. Really good question. I think the underperformance, a lot of it had to do with the exposure to the U.S. As well as just the First Horizons deal that was kind of in the mix there. I think the termination of that deal is something that's actually really good for shareholders, given the outsized capital levels of the bank now at the high end of the group. And it just gives them a lot of optionality in this environment. And not to mention, they also have the shares of Charles Schwab that they hold, so that gives them further optionality. And I think they'll look to do more deals in the U.S. and grow that exposure.
Does it have to be deals, you think, as a catalyst for the stock? I mean, if they announced a huge buyback or a dividend, would that be well received as well?
I believe so. I think investors want to see just that capital put to work in the best possible ways. So you want to look at what your return on your investment is. And I think at these capital levels, the bank will look at doing what is best. And that could be a mix of everything. It could be buybacks, it could be dividend increases, and it could be opportunistic M&A in the U.S.